raising mortgage and other lending rates, but mortgage rates most particularly on home buyers, and they're not passing on higher yields to savers. Kayla Tausche has that part of the story. She's busting a money myth today. But first to Diana Olick on how rising rates are affecting home buyers. Diana?
Rising mortgage rates are never a good thing during a housing recovery, but especially today when borrowers are facing tighter underwriting and higher fees from mortgage insurers, including the FHA. Now, I did a little math for you so you can get the whole picture. You're buying a home today. Let's take the median home price in May from the realtors of $208,000. Put 20% down and get a $166,000 loan. Back in early May, when rates were at 3.5%, you were paying $745 a month. That's not including insurance and taxes. Bump the rate up to 4.5%, and you're paying $841 a month, a 13% jump. This affects not just the amount of home you can buy, but it also affects what you can qualify for, given today's strict debt-to-income levels used by lenders. Loan officer Dan Green of Waterstone Mortgage says his refi volume is slowing, but there are still millions of homeowners with rates around 6% who could lower their payments. For buyers, he says, most don't realize how fast rates are rising. He says today the 30-year fixed is pricing near 4.75% with no points. And rates are rising just as home prices are rising. Yes, we're still well off the highs of the housing boom, but we are seeing in some local markets double-digit price increases from a year ago, and that's just not helping. Plenty more online, realtycheck.cnbc.com. Tyler?
All right, Diana. Diana Olick reporting for us. Now to Kayla Tausche with a look at why banks are not passing on these higher yields. Let me just say, they're not passing on because they want to make more money for themselves, right?
Well, they would hope so, but also just because the benchmark that these savings accounts are tied to, they don't have to and they don't need to. Their mortgage is about the only place where higher yields are going to affect you immediately because these savings accounts and other personal financial products are based on the Fed funds rate, which has been at or near zero for the last 4+ years. And even though yields on treasuries and other fixed income products are spiking, these products won't earn you more until the Fed raises rates, which is possibly not until 2015. Right now, the average savings account will earn you only 0.08%. That's according to Bankrate. Accounts at big banks like Chase and Wells Fargo will earn you only 0.01%, while online-only accounts like Ally Bank will pay you just below 1%, which is a little bit higher. While you may be missing interest on savings, you're also not paying it on some of your other borrowings that are tied to this Fed funds rate. Also, in the last 6 weeks, as yields skyrocketed, the average interest on a 5-year new car loan stayed put at 4.12%. The average rate on a variable credit card barely budged either. So, Tyler, even though you would like to be earning more on your savings, once those rates start to rise, it'll be both a blessing and a curse.
I guess rates on home equity lines of credit will stay where they are because they're generally pegged to the prime rate.
And if the price of your home is rising and you can get more out in credit, then perhaps that's a good thing to do while these rates are still low.
All right, Kayla, thanks very much. Kayla